1. Start with energy, explain with authority, highlight with emphasis, and with warmth. As of 10:03 a.m. Eastern Time, Applied Digital Corp, ticker APLD, is trading at $22.60 per share. That is down 46 cents or just about 1.99% on the session. The market is clearly churning on this name, with a volatile day already showing a low of $20.55 and a high of $23.10. What's fascinating and what most of the surface-level chatter is getting wrong is why it's volatile. The common expectation is that this is just another crypto-related stock getting tossed around by algorithms. The reality, however, is that this stock is in the middle of a massive company-defining capital raise that has nothing to do with Bitcoin and everything to do with the future of artificial intelligence. The trading volume, already explosive at over 8.2 million shares, tells you this isn't a quiet day. This is a battleground. The market is trying to decide if Applied Digital is taking on too much debt or if it's brilliantly securing its place as a critical infrastructure provider for the next decade. The expectation for many who might just be tracking this on a simple Robinhood app or through a basic SoFi Invest dashboard is that APLD is a stock that follows the swings of the digital asset market. It was, after all, formerly named Applied Blockchain. That name created a strong association, and it's a hard one to shake. The reality, however, is that this company is in the final aggressive stages of a shift away from that volatile, low-margin business and into a high-performance computing or HPC infrastructure builder. The reason the stock has been under pressure this week and why we're seeing this chop today is because the company just priced a massive $2.35 billion offering of senior secured notes. Now, for most companies, announcing billions in new debt sends investors running for the hills, and we've certainly seen a 20% pullback since that news hit. But this is where you have to look deeper than the headline. This isn't a company taking on debt to survive. It's a company taking on debt to build. That $2.35 billion is the required capital to fund the construction of its new data centers in North Dakota, the very data centers that are already contracted out for the next decade and a half. Let's look at the recent movement because it tells the story. The stock has been on an absolute tear in 2025, running from a 52-week low of $3.31 to a high of $40.20. That's a 300% plus move for many who got in early. This recent pullback is the market's attempt to digest that massive run and, more importantly, to handicap the risk of this new, capital-intensive phase. Today's intraday swing from $20.55 to $23.10 shows profound indecision. The bears see the $2.35 billion in notes. They see the BB- rating from S&P, which is non-investment grade, and they see execution risk. The bulls, on the other hand, see that the company just drew another $787.5 million from Macquarie Asset Management and has secured the $2.35 billion to fulfill its obligations to its main customer, CoreWeave. This isn't like trading Apple stock, which is a mature, cash flow positive behemoth. This is a high-stakes construction and growth play. People using more sophisticated investment tools, perhaps on Interactive Brokers or the Fidelity trading platform, are watching the capital flow, not just the price. They see that this debt is the fuel. Without it, the company's massive $11 billion in contracts are just pieces of paper. With it, they become a reality. So what does Applied Digital actually do? Let's clear this up because the old narrative is what's confusing people. The expectation is crypto mining. The reality is AI infrastructure. The company has two main segments. The first is its legacy data center hosting business, which primarily provides co-location services to crypto miners. This is their past. The new business, the one that matters, is its high-performance computing, or HPC, infrastructure builder. Its flagship project is the Polaris Forge 1 campus in Ellendale, North Dakota. Why North Dakota? Because a recent Morgan Stanley report warned that the AI boom could create a massive power shortage for data centers by 2028. Applied Digital went where power is cheap and the climate is cold, reducing cooling costs. This is the strategic moat. They have signed contracts, specifically with AI cloud provider CoreWeave, to fill 400 megawatts of capacity at this campus. This one deal is worth an estimated $11 billion in total revenue, locked in for an approximately 15-year term. This is the entire story. APLD is not a speculative crypto miner. It is becoming a specialized long-term landlord for the AI boom. Now, let's connect this to the financials because that's where the tension between expectation and reality is loudest. The company's most recent earnings report for the first quarter of fiscal year 2026 showed revenue of $64.2 million. That was an 84% increase year over year. But here's the critical part. $26.3 million of that revenue came from tenant fit-out services. They're literally getting paid to build the facilities for their tenant. However, the company is not profitable, not even close. It reported a significant net loss, and its operating expenses, particularly stock-based compensation and general administrative costs, were way up. The expectation is that losses are bad. The market sees red ink and sells. The reality is that this is exactly what a company in this phase is supposed to look like. They are in a full-scale, capital-intensive construction phase. Profitability is not the metric to watch. Execution and contract fulfillment are. The fact that their adjusted EBITDA, a non-GAAP measure, just flipped positive to the tune of $500,000 shows that the underlying business is beginning to turn the corner, even as they spend heavily on growth. This is the kind of aggressive growth story that traditional Fidelity mutual funds might avoid, but it's perfect for a growth-focused individual brokerage account where an investor understands the risk-to-reward ratio. Who else is in on this? This isn't just a retail-driven stock. The institutional ownership data is compelling. As of the last quarter, Applied Digital had 512 institutional owners holding over 64% of the company. More importantly, the number of institutional owners increased by over 15% in the most recent quarter. This means that while some retail investors on Robinhood might be scared by the debt, big money managers at places like Fidelity and other large funds are initiating and adding to positions. They are doing the math. They are looking at the $11 billion in contracted long-term revenue and comparing it to the company's current market cap. They understand that you have to spend billions to make billions. This is a very different setup from Tesla stock or Nvidia stock, which are a bet on innovation and product sales. This is a bet on infrastructure. It's a bet that Applied Digital can execute, build these facilities on time, and turn on the cash flow spigot. The bulls are betting that this stock will be re-rated by the market, moving from a volatile builder to a stable, predictable, high-growth utility. This brings us to the future outlook, the bull and bear case. The bull case is simple: execution. If Applied Digital successfully builds out the 400-megawatt campus on time and on budget, and CoreWeave begins its tendency, the $11 billion in revenue starts flowing. The company will have proven its model. At that point, it can take its proven blueprint and secure its next major hyperscaler tenant, and reports say they are already in talks with other major players. In this scenario, the stock is no longer valued as a risky builder, but as a core AI infrastructure holding, the kind of thing that Schwab Intelligent Portfolios or other robo-advisors might add for their clients seeking investment help with exposure to AI. The stock would likely re-rate to a much higher multiple, reflecting its predictable, long-term cash flows. The $40.50 median price target from analysts would seem conservative. But the bear case is just as straightforward and rests on three major risks. The first, and the most significant, is execution risk. Building data centers of this scale is incredibly complex. Any delays, any cost overruns, any failure to meet the technical specifications for high-density liquid cooling, and the whole model breaks down. The $2.35 billion in debt is a ticking clock. The second risk is customer concentration. Right now, the entire bull case is built on CoreWeave. If CoreWeave stumbles, if its own business faces headwinds, or if it disputes the contract, Applied Digital is in a world of trouble. This is not a diversified business. They have all their eggs in one very large $11 billion basket. They are betting the entire company on this $11 billion CoreWeave contract. Based on this, comment below, do you see APLD as the next great infrastructure play, Or is this customer concentration just too risky? Finally, there is financing risk. The company is burning cash to build. It needs this debt. If capital markets freeze, or if interest rates spike further, its cost of capital could become unmanageable. This is not a safe set-it-and-forget-it investment for your Fidelity IRA. This is the active self-investing side of your portfolio. So, as we watch APLD trade at $22.60, down 2% on a day of heavy, undecided volume, the narrative becomes clear. The market's expectation is that the stock is weak, reacting to a massive new debt load. The reality is that this debt is the very key to the company's future. It's the necessary pre-negotiated capital required to unlock $11 billion in contracted revenue. The company is shedding its old, speculative crypto identity and